Hello everyone, this is Professor Kent. Today's recording is an introduction to inventory. What is inventory? And we are going to talk about chapter 7 and 7 is an inventory. Again, this is the introduction to accounting. In that course, we have an inventory. When we think of an inventory, what is an inventory? Inventory is the item purchased by a company. Why do they need to purchase it? They need to resell that to the customer. So that's what inventory is. Or we also have an inventory that is used to manufacture a product that is sold to the customer. So we can always have an inventory for if we want to manufacture a product. Once we complete that product, then it's sold to the customers. Now, all company with exception to service have an inventory. If your business is a service, you will not have an inventory. But only companies that have an inventory if you're buying a product and selling it, or you're making a product and selling it. When you think of from the manufacturer point of view, from manufacturer they will have they're gonna have three different inventory. When you're manufacturing a product, your inventory will start from raw material. You purchase a raw material, and that material, then you transfer that material to the work in process inventory. That's where you make the product. After the product is made, then it goes to the finished goods, means now they're ready to be sold to the customer. From there, then it goes to the cost of goods sold, and that's when it's gone out to the uh, to the customers. So that in under for a manufacturing company, they have three inventories. We have a raw material inventory, we have a work in process inventory, and we have a finished goods inventory. Going in the same line of inventory, what goods are included in company's inventory? So we have an inventory. What should be included in that inventory? uh, what should be our inventory, what would be somebody else's inventory? That's what we're looking at it. Now there's 2 points when we look at it. We have an FOB shipping points and FOB destination points. If you are a company, when you have a company, what are you doing? You're a company and you're selling an inventory, so you're selling a product to somebody. So if you're selling an inventory, when we think of a FOB shipping point, so if you're shipping FOB shipping point, that means that soon as you ship the inventory, it belongs to the buyer. So it shouldn't be part of your inventory. It will be part of your buyer's inventory. FOB destination. So FOB destination is its destination is, it is your inventory till it reaches the destination, means till it reaches the buyer. So it is our inventory till it reaches the destination. So this is the sort of an example of it that is right here. They said you have a factory, FOB shipping points, FOB destination points. So this is an example. So when you have a shipping point, buyer owns the inventory when it leaves the seller's premises. Buyer owns the inventory when they arrive at their premises. So that's what happens. Now when we're talking about inventory system in accounting, we have two inventory system. One is called a periodic inventory system, and perpetual. Under there we have different type of method of calculating the ending inventory and cost of goods sold. When we think of the first one is my periodic inventory system. When you think of a periodic, what includes in my inventory, what includes in my inventory? So we have an opening inventory, which is also called the beginning inventory. Last year's ending inventory becomes the next month's next period's beginning inventory. When you purchase it, that increases your inventory. And what we have is, that's the, if you add both of them, whatever we started off with, but plus your purchases, equal to your cost of goods sold available for sale, minus your ending inventory. Ending or inventory is what is left in our warehouse, then that is equal to your cost of goods sold. Now what we're going to do is we're going to do first example, and from this example what we're going to do is we're calculating the cost of goods sold for the company. When you do that, we need it again. You have seen it before, or if you haven't seen it, we're going to show you how to calculate the cost of goods sold when the company using a periodic inventory system, which is your first inventory system. Tech Limited counted its inventory at the end of the year, determined that. So what they did is they did a physical count at the end of the year. They said that their ending inventory is 15,000. They have it on hand. The company has started the year. The company had started the year with the inventory costing 9,000. So that will be my opening inventory. So I started my year with the inventory. I started my year with $9,000. During the year we purchased. So plus your purchases is what we have it available to sell. So add your purchases. In this case my purchases was 27,000. If I add both of them, we call it cost of goods available for sale. And that is, if I add it, that is $36,000. So when we did the physical inventory of our when we did a physical inventory at our warehouse, we counted that we have an ending inventory, or what the inventory that we have it on hand. The inventory that is still on hand is called an ending inventory. If that's the case, we minus what we have it left over. That will tell us what did we sold to customers. So cost of that will give you cost of goods sold. In that case we sold 21,000 worth of the inventory to the customer. So this is how we calculate the cost of goods sold if the company is using a periodic inventory system. Now if the company using a perpetual inventory system, what happens is your inventory gets updated automatically when we sell a product. So that's what happens. So it says perpetual inventory system, a company's inventory information is updated continuously. In continuously means every time you sell it, the inventory gets updated. When that happens, so if you look at it, everything is exactly the same way we did it under the periodic inventory system. Under the periodic inventory system, we have opening inventory, we have purchases minus your cost of goods sold. It is updated after each sale, and then we have an ending inventory. So that's the ending inventory in your books. But then when you do a physical inventory, and when you count the ending inventory, that should be on hand. So that's according to the paperwork, that's what you have it on hand. When you do a physical count, so you still have to see the you still have to do a physical count to see what happened to your inventory. So this is what you have it on hand. So when you told somebody to do a physical count, and that will give you actual that you have it on hand. Difference between the both, either we have, if you have a less inventory, then we have a shrinkage, or we can say it's a lost, or we can say it is stolen, right? So that's what is called the if you have a shrinkage. So if you have a shrinkage, we say, why do we have a shrinkage? Is it due the inventory is lost, maybe it's broken, or it's stolen, or maybe something happened to that inventory. So that's how we calculate the ending inventory under the perpetual inventory. The purpose of perpetual inventory system is that the inventory gets updated automatically. So now when you do, they say what are the key differences between the periodic inventory system and perpetual inventory system. So now if you look at it, this is when you do journal entries. Now we learned how to do journal entry when you purchase an inventory, when you sell an inventory. Now we learned in this one we have two inventory system. One is a perpetual inventory system, the other one is a periodic inventory system. There's a difference. Perpetual inventory, the timing of the accounting entries are continuous, every time inventory is purchased and sold, you have to update your inventory. In this case, when we purchase it, we record the purchases, and at the end of the year, that's when we update the inventory. So if you look at it, when you purchase an inventory, you debit the inventory, credit your cash under the perpetual inventory system, and at the time you sell, if you sold it for cash, you debit the cash and credit your sales, and you update the inventory, what it costs the company. And then at the end of the year, there is no adjusting entry. But if it was company was using a periodic inventory system, there is an entry at the end of the year. But before you go to the end of the year, what happens is we don't update the inventory at the time you sell. So when you purchase an inventory, instead of going to the inventory account, it will go to your purchase account. Then when you sell an inventory, when you sell a product, we have a debit cash or accounts receivable, credit is sales. So we update the inventory at the end of the year by closing this is what we call is by closing it, by closing our inventory accounts. So that's what we do. So this is my beginning inventory, this is my ending. We have a cost of goods sold, and then we have a purchases. So what you're going to do is on your income statement, you are going to only have a cost of goods sold under the perpetual inventory system, but we're trying to put it in the same number under the periodic inventory system. So inventory account is required. It doesn't matter if it's a perpetual inventory or a periodic inventory system. We still have to do a physical count at the end of the year to see what happens to our inventory. Do we have what we said we had it in our inventory? Now going further, when we talk about inventory, what is included in the inventory? Now if it's for retailer company and for the manufacturer company, so what is included in the inventory? The purchase, of course, you purchase an item, that should be included in my inventory. Any non-refundable taxes, in this case we have a PST is non-refundable, or we call it a sales tax. Sales tax is a non-refundable, so that should be included in my inventory. Also the shipping or a transportation in, so the any expense that we have to bring the items into our warehouse. If you're buying product from overseas, you have to pay the import tax. So they all these are part of my inventory. They are part of the inventory cost. Now for a manufacturing company, you purchase a raw material, that is part of your inventory. Now on that material, what we have is we have a sales tax. We pay sales tax, that should be part of it. We have shipping and transportation in, we have import duties. Now we have a raw material, and then what we do is we put a labor and overhead, and that should be part of my inventory costs. So going further, so what are the cost formulas and why they are necessary? So now the cost formula is to calculate the cost of goods sold and ending inventory. That's why we need a cost formulas. Now these are the three different method under the periodic inventory system and a perpetual inventory system. We said we have two, one is a periodic inventory system, one is a perpetual inventory system. Periodic is inventory gets adjusted at the end of the year. Under the perpetual, inventory gets adjusted automatically. So these are the three methods that we need to learn under the periodic and under the perpetual. So what we're going to do is it doesn't have to be in this order in the test in the textbook. This was my first example, and we're going to do this example with weighted average. So we're going to calculate what we need to calculate. We needed to calculate the cost of goods sold and ending inventory if we are given this example, and we have to follow the weighted average calculation to calculate my cost of goods sold and ending inventory. um, so let's do that. So they made our life easier here. So they told us my opening inventory is 100 units. I multiply by per unit, that will give me the cost of this, the total cost of the opening inventory. Then I purchased 150 units. The cost of the inventory to us was $16. So that's what is this cost of goods available for sale. So we're using this, what we're doing is we're using a periodic inventory system. The reason why is it periodic inventory system, they um, they didn't tell us we're using a periodic inventory system because we needed to calculate the cost of goods sold. So this COGAS stand for cost of goods available for sale. When we're using a weighted average calculation, what we needed to know, we needed to calculate, first we needed to calculate the weighted average cost per unit. And how do we do that? The first step is to calculate the weighted average cost per unit. So my total cost of your inventory was 3150. Number of units that we have was 250. So the weighted average cost per unit is $12.60. So that's the weighted average. When you do cost of goods sold, so how many units did we sell sold? So in this case, on April 3rd, it purchased 150 units for $16, and the unit cost was 24. On April 15, what we did, we sold 150 units. So if I'm using a weighted average, so I will sell it at the weighted average price. So my cost of goods sold will be 150 units at 1260. It will give me 1890. So cost of goods available for sale minus your cost of goods sold, what would that give me? It will give me my ending inventory. So my ending inventory will be 1260. And if I had 250 units, now I sold 150 units, I have 100 units left, and the cost of each unit will be 1260. So this is a weighted average weighted average method to calculate the cost of goods sold and the ending inventory. Now this is the next one is first in first out. So first one in, we have to sell it first. So again, you have a cost of goods available for sale. We're using first in first out. So what we did is our cost of goods sold, how many goods did we sell? Cost of goods sold, how many units we sold? We sold 150 units. So when we say first in first out, you sell what was the first one came in. So we will sell 100 units at $7.50. But we sold what we did is we sold 100 units at 750. So that's what we did. Then what we do next one is that 50 units from my next inventory. In this case, it is $16. So that's what is my 16. So we sold 100 units at 750. Then we sold 50 units at 1650. So what we did, we made up that 150. This is my first inventory, they will be sold first. Out of my second inventory, we only sold 50 units. So all together, then this will give me $75, this will give me 800. So all together what we did is I have 1550 cost of goods sold if I add both numbers together. Then what we need is, then after that we calculate my ending inventory. So cost of goods sold minus cost of goods available for sale minus your cost of goods sold is my ending inventory, and that is your 1600. So that's my cost of goods sold, and that's my ending inventory. It will be 100 units at $16 left. So now if you look at your ending inventory, and your cost of goods sold are different under the um, both methods that we just did. Then what we're going to do is, now we did it with periodic inventory system. Under the perpetual inventory system, you calculate the ending inventory and cost of goods sold differently. That's what you're going to do. So we're going to show you how do we calculate it. Again, we needed to calculate the three under the both perpetual and periodic. So the the specific the specific identification, they will tell you which units you are selling. So it is both, it is same under the periodic and under the perpetual. So they said, based on the information that is given to us, what we needed to go do is we need to calculate cost of goods available, cost of goods sold, and the ending inventory. So our first method is they are going to tell you which units they are selling. But before we could sell it, we needed to know what we have available, and then what we have it what we sold, and what is my ending inventory. So they told, when we look at it, we have a September 1st, we have a beginning inventory, we have a BEG, stand for beginning inventory. We have 5 units at 65, and that gives me $325 for my first one. Then what we did is, on September 1st, what we did is we purchased. So what we did is we purchased. How many units did we purchase? We purchased 10 units at 74. So we purchased 10 units at 74, so then that gives me 740. So they told us on September, if you're doing a perpetual inventory system, you do it in an order. So I'm just going to put it under here, my cost of goods sold, and I have what is my left is my ending inventory. They told us we sold 9 units. We sold 9 units, so that is my selling price. So we want to know what is the cost of those units that we sold. So they said, and they, under the specific identification, let's assume that the 9 units that we sold is on September 15, 4 was from the beginning inventory. So what we did is 4 from the beginning inventory, so 4 units are sold out of this one. So at 65, if I had 5 units, I sold 4, I have 1 unit at 65 left. Then going further, they told me 5 units they sold it out of my September 5th purchase. So I will sell it at 74, and if I had 10 units, I sold 5, I have a 5 left at 74. So my cost of goods sold 260 here, 370. And then what we did is we purchased more. On September 27th, we purchased 6 units at 81. That will give me 486. So when you do this kind of question, you could do it, if the question is asking, this will be cost of goods available for sale, and that will be your, if you add up all the numbers together, that will be your cost of goods available for sale. When you do that, we have 1551. And then this, what does this give you? Just the word at the top, we have a cost of goods sold, and that is your 630. And then difference between the both will give me my ending inventory, and that will be 931. So that will be your ending inventory. So if I were to do that, that will be my 65. I don't have a number for that. I have to use my phone to calculate my ending. 5 times 74, and that gives me 370, We also didn't sell our 6 units at 81. That gives me 486. So if I add all of them together, that will be my ending inventory. Going further, we're gonna do our first one. We did this specific identification method. Now we're gonna do a weighted average method, but we're gonna stick to our perpetual inventory system. When you do perpetual inventory system, inventory gets updated at the time you sell it. So inventory gets updated at the time you sell it. So let's do we're using weighted average. So let's do that. We have a beginning inventory. Keep track of the dates. We have a beginning inventory. We have 5 units at 65. We have 325. The dollar value of this inventory is 325. Then going further, what we have is we purchase. So when you purchase, we purchase 10 units. And when did we purchase it? On September 5th. We purchased 7 at 74. The value of the units are 740. When you're doing a weighted average, you're doing a perpetual. We sold on the 15th, we sold 9 units. We wanted to know what was the weighted, what was the cost using the weighted average. In order to do a cost, I will add my both numbers. In this case, it will be 1065 and this will be my 15. How do I calculate it? You're gonna take 1065 divided by your 15, gives me $71. So my weighted cost for this inventory is $71. So that's what you're gonna do. You're gonna automatically do it you could do it at the side. 1065 divided by 15 gives me 71. I will sell the 9 units at $71. So the cost of goods sold is $69. Then if you out of the 15 you sold 9 units, and you sold cost of goods sold is 9 units at 71, and we want to know what was my ending inventory. So let's work out my ending inventory. I sold 9. I'm left with 6 units at $71, and the cost will be $426. Then next we have a purchase. So we are going to go to September 27th, and what we did is we purchased. What did we purchase? We purchased 6 units at 81, and then we didn't sell anything, so whatever we have is left. 6 at 81 and gives me 486. So my ending inventory will be 12 units, and the cost of that inventory will be 912, and this is my cost of goods sold, which is 639. If I add all these ones, and that will give me cost of goods available for sale. So that will be, I have to use a calculator. 1065 plus your how many units, and that is my 486 plus your 486 gives me 1551. I minus the 639, I will get 912. So that's what you would do. So I'm just gonna 81 equal to 486. If I add these two numbers, will give me the cost of goods available for sale minus your cost of goods sold, will give me the ending inventory. Now we're going to go to our first in first out inventory, and we are going to use the perpetual inventory system to calculate it. Perpetual. When you do that, again we are using first in first out. So first one in, first one will go out. Again, you start at the beginning inventory, that is on September 1st. We have 5 units at 65, and that will give me I just have to see what number I get. That will give me equal to 325. We purchased on September 5th. We purchased, what did we purchase? We purchased 10 units at 75, and that gave me 740. We are going to do cost of goods sold, and whatever is the leftover will be my ending inventory. So then we sold how many units? We sold 9 units. So that's what we did. We sold the 9 units. And what method are we using? We say FIFO, first in, first out. So this inventory was my first inventory that came in. So I'm gonna sell 5 units at 65, but I sold 9 units. So 4 units will come out of my second inventory. The cost of that second inventory is 74. This is 325, and that is $296. So if I sold 4 out of that, we sold 4, so I have 6 unit at 74 left at 4444. Then we have a next purchase. My purchase is for 6 September the 27th. We have 6 units at 8. We purchased an inventory. How much inventory did we purchase? We purchased 6 units at 81, gives you 486, and then we didn't sell any, so that is still left to be sold, and that will be part of my ending inventory. If I add these two numbers, that will be called my ending inventory. And this is my that is my cost of goods sold. And what is this called? This is called cost of goods available for sale. Available for sale minus your cost of goods sold equal to your ending inventory. So if I add up all the numbers together, that will give me the purchases. Going further, now my next one is, this is a method is used when it's an application of lower of cost and net realized value. So sometimes we buy an inventory, it is a stale inventory. So what we do is we do an adjusting entry at the end of the year for our products by using the net realized value. So when you have it, in this case, we have to calculate the cost, and the net realized value will be given to you, means how much can be sold, the inventory you have, how much can that be sold in the market. So when we look at the method called lower of cost and net realized value, so what happens in this case, we have product A, the cost was 2,000, and it could be sold at the market for 150. So the lower price is 1,500. So that's what it is. The cost is what is sitting in the books. This is what we are calculating, what can be sold in the market. So the lower of cost and a net realized value. When you compare the part B, the cost is lower, and here your cost is also lower. So if you add them up, the value used for the value that you will use for your inventory will be 450,000. The cost of that inventory to you was 4550. So this is the value that is sitting in your books. So what you're going to do is you have to do an adjusting entry. So what will be your adjusting entry? You will take your lower of the cost and net realized value minus your what is already recorded in your books. So this is the cost that is recorded in your, sorry, this is the cost that is recorded, and this is when you use the net realized value, that will be the value of your inventory. So you need to do an adjustment at the end of the year for $500. So the difference between the cost and the value used for to calculate the inventory using the lower of cost and net realized value is 4050. So I need to do an adjustment. My adjustment will be debit will be my cost of goods sold and credit will be my inventory. This is what we do at the end of the year. We need to do an adjustment using the, if the company was using a lower of cost and a net realized value. This was, there's more to this chapter 2. For this video, this is it for this video. Thank you for listening, thank you for tuning in, thank you for subscribing to my channel. Please let me know if there's anything else you want me to record, or you can give me thumbs up if you like the video, or if there's something you want me to make a change. Thank you for coming and watching me. Thank you. Bye.